For as well, because we actually, on top of the two presenters that we have today, who are kind of specialists in their own area, we have both Reese and Mark are with us today, who are going to be talking about kind of what they specialize in a little bit as well. But we also have some other accountants that have joined us from MNP. I'll get them to kind of raise their hand up on the side there. I'm going to single out all the accountants. So the big thing, the reason that I point that out is because it's not very often that you get the opportunity to interact with so many professional accountants in such a kind of closed off setting. So I really encourage you, when questions are, when we get to the question portions, ask as many questions as, I'm going to put the accountants on the spot, but really ask the questions that come to mind. And just so you guys know, afterwards, MNP has been gracious enough to bring in some pizza for everybody. So I would say really take the opportunity to get to know each other, eat some pizza, talk to the accountants, talk to us. I mean, this is just as much a networking event as it is a business plan competition. So without any further, I'll pass it off to Reese.
Thank you. So bit of a change of gears here with this presentation. It will be a little bit different. I don't have, my slides are much more boring than the last ones, but put up with it, and hopefully you guys can get something out of it. As for questions, I was thinking if you guys have any questions or need clarification on the slides, please stop me at any time and I can give that, but they're pretty straightforward, so hopefully you don't. If not, at the end, like was said, any one-on-one questions about your business or any accounting problems, issues, feel free to pick on any one of us. How do I get to my slides here? Oh, never mind. There we go. Okay, so these are some of the major issues that will face companies and face entrepreneurs upon startup. So throughout this presentation, I'm going to kind of talk about things that help make sure that you avoid these problems and avoid these issues. So I will discuss why people start their business and the entrepreneurial myth, the different types of owners and employees, determining your business and operations, HR and people management, and I'll finish with a quick example of a business model that we use at MNP. The entrepreneurial myth. So most people who start a business are entrepreneurs. This is a myth because it's just not true. Most people that start a business are actually technicians. So they're the doers behind the company and the ones that actually produce the product or make the product. So really, think about yourself and think about what before you got into business. Where were you at? Likely you were probably a doer and a technician and working for someone else. So what were you probably doing? I mean, it could be mechanic, engineer, anything along the lines of that. So whatever you were doing, you were probably good at it, but the problem was you were doing it for someone else. So the idea is, what can I do to make sure I can do this for myself? And how can I become successful taking what I know technically and turning it into a business plan? However, in the excitement of thinking about starting your own business, you can fall into a trap that is called the fatal assumption. So an individual who understands the technical work of a business can successfully run a business that does technical work. The reason that this is a fatal assumption is, again, because it's just not true. The technical part of making a product is so much different than a company that how it runs technically. So it's not your greatest asset being a technician. It can actually become your single greatest liability. And the reason that is because you will, as a technician, often revert back to, I know how to do it better than the person who's doing it right now, so I can do it myself. So it's very hard to always rely on other people to do the work when you know, I know how to do this, I can do it better, I can do it faster, I can produce it with less costs, let me do it myself. So being a technician is not a bad thing, and many of us in this room are, and businesses can't survive without them, but there's definitely other things involved with the company. So this brings me to the three types of owners and employees of businesses. So many of you will identify with one or even two types of the people I'm about to list. It's important to consider where you fit and what your strengths and weaknesses are to ensure that upon startup of a company, you can avoid some of the pitfalls that do exist. I've talked about technicians a little bit already, but this will hopefully clear it up a little bit more. So technicians are doers. If you want something done right, you do it yourself. That's technically their motto. They know how to get things done. They're very skilled and competent in their field. They live in the present, so they worry about what is on your plate for today. And they're happy as long as they're working. Happy to do the physical work, typically working on one project at a time. Thinking is unproductive unless it's about the work to be done. So technicians know that if it weren't for them, projects would not get completed. So why waste time on hypotheticals? Why waste man hours? Sorry, I have to take this. My wife is 8 months pregnant. So.
That's how nerds.
Good to go? Okay, so talking about technicians and starting business. Here is maybe not a typical cycle, but a possible cycle for technicians when they start their own business, and it's called the technician tragedy. Starting with exhilaration, you're free from your old boss, you're able to do your own thing, you're used to working long hours, but now you don't do it grudgingly because you're working for yourself. Followed by terror. Sorry. I don't want to ignore any more of those. Okay. Terror. Not only are they doing work you know how to do, but now you're doing things that you don't know how to do as well. So being a technician, now you have to take on, if you start your own company, so you have to take on other roles. So you'll be taking on accounting roles, you'll be taking on marketing roles, supplier, shipper, all those other roles. So as a technician, now you're falling behind the eight ball, and you have a lot of balls in the air, and you're juggling a lot of things all at one time. So overloaded technicians, they seek help, usually technical help. First step is probably a bookkeeper. That's typically what technicians and a lot of business owners don't want to do. Followed by exhaustion. So you work harder, but you have to stop growing because you can't continue to do this without more technical help. This is followed by despair. So often the technician-run company now gets smaller. That's the only way to continue operations, is to get smaller and kind of forget about those original growth plans. The next type of person is entrepreneurs. So they're visionaries, dreamers, catalysts for change, and their focus is change and growth. They live in the future, always thinking what if, and if yes, when. They fill a perceived need in an innovative way. The commodity isn't as important as the way it is delivered. How must the business work? Where the technician will ask what work has to be done, the entrepreneur will ask how to optimize this work. They have a vision of a system for producing outside results for the customer, resulting in profits. So a technician will look at things the opposite way. They'll look at inside work, produce results for themselves, resulting in profits. They change the present to match the future vision, where a technician, again, will look at this opposite. They will be looking at the future as something that is an ideology and very hard to attain, and they often want to stay with the status quo. Change and growth are keys to the entrepreneur's vision. The last type of person we have are managers. Managers are pragmatic. They worry about the details. Managers like things to be in order, well-planned, and predictable. Managers are able to see the problems and not only the big picture. To managers, work is a system of results, simply cogs in a wheel. Sorry, my wife has me all flustered here. Excuse me. Managers compulsively cling to the status quo. The manager builds a house and lives in it for the rest of his life. An entrepreneur will build a house, and the second he finishes, start building another one. A good quote from Michael Gerber is that it's the tension between entrepreneur's vision and manager's pragmatism that creates the synthesis from which all great work is born. Remember though, a business needs all three. Okay. So these skill sets are in conflict, but conflict can be good if it's balanced properly. Remember that one person can have attributes of all types, and it's important to be able to identify your strengths and weaknesses when you start your company. Sorry, my wife's calling me again. I don't know.
I've worked with other companies before, and when looking at making a purchase for equipment, they would say, "Oh, my account won't let me do that." How much control is there between the relationship of the two?
I think it's safe to say we have zero control. I think a lot of business owners see their accountant as like a trusted advisor, where they bounce ideas off and ask for advice. Whether the owner listens or not, it's definitely up to the owner to go ahead with the purchase or whatever they want. Yeah.
I think the other thing we often see is that maybe when, okay. Good luck.
Thanks.
That's your point. The other thing we often see is that the company
Sorry, guys.
and the individual. Good luck. The company and the individual are often in the entrepreneur's mind or the business owner's mind the same thing. So my money personally, it's my company, it's my money personally, and there's a division for that for tax and accounting and the way that works. That's where a lot of people will think, oh, we don't have that money, but it's that there's consequences to taking that money out that have to be dealt with.
It's a good excuse for
Don't excuse.
Yeah.
I'm Kelleen, and this is Marvin.
I'm Marvin.
And we have not seen these slides. So, it looks like operations is up next.
Okay, so I think what Reese was getting at is that we each have either entrepreneur, manager, or technician in us. Whether we have 100% technician or a mix between all three, but it's best to identify who you are and what your strengths and weaknesses are in that. And I guess we roll on to operations.
Well, this slide says exactly what's up there. So we're just going to touch on a few things, deciding where you want to go for your business, building a strategic plan to get you there, streamlining your vision, franchises, and building operating systems.
I have a question in regards to the strategic plan. So as you have your strategic plan of how you want to get there, when, maybe you're going to talk about it. I was just wondering if like the strategic plan is a living document. You're always changing, correct? And that's okay. You don't have to say, this is the plan, I'm sticking with it.
I think you probably, it's the plan, and you sort of make adjustments to it as you go. I don't think you want to make a plan and then do a complete 360 1 year later and go the opposite way. You probably have the focus in the future, but then you slow, like if things aren't working out, you make adjustments to the steps you're trying to do to get to that end goal. So the vision describes your dreams, hopes, and desired future. It's what you really care and are committed about. So it's basically your passion, what the reason why you started this business. The next is the mission statement, and that's how the business creates value and the business that you're in.
So as an example, for MNP, our vision is that we will be the preeminent full-service mid-market accounting firm and business advisory firm in Canada. When you shift to our vision is to help our clients succeed. So the two are quite different, but they work quite well together.
You have all the notes there.
I know. I took a good spot. The balanced scorecard is a good way to streamline your company's vision. So there's 4 main parts, and a lot of us at the office will actually use this when we sit down and discuss how businesses are operating and how our clients are working. We'll go through the 4 different quadrants, and sometimes that's where you can find some really interesting things about your business. There's a lot of people who will focus on one. You'll focus on your financial indicators, so what your bottom line is, how much money you're making, what your expenses are. And unless you have a kind of a vision that encompasses all 4 parts, we often find one part is lacking. So you struggle to keep your customers or your people employed, your operations aren't running efficiently because you're cutting costs too much or you're letting costs run wild. So there's kind of the 4 different, the the 4 different COPS model, which I'm sure you've probably heard about a lot, but it is one thing that we do use quite often, focusing on all 4 quadrants. Can you still switch?
Like that's good.
You're just really knocking it out of the park today. Sorry, guys. Okay,
Oh, look at
perfect.
Got it.
So the franchise prototype, the true product of a business is the business itself. So the example that they use here is for franchising, remember that the true product is the business itself. So the story of Ray Kroc and McDonald's. Ray was a milkshake salesman in San Bernardino, California, and he was an entrepreneur. He came across the McDonald brothers, who were technicians, and their business model, hamburgers, were produced quickly, efficiently, and inexpensively. Best of all, anybody could do it. Evident that was the McDonald brothers had created was not just another type of hamburger stand, but a money machine. So Ray convinced Mac and Jim McDonald to let him franchise their method. 12 years and several $1 million later, he bought them out and went on to create the largest retail prepared food distribution system in the world. The true product of the business is not the product itself, but how well it sells. What Ray understood at McDonald's was the hamburger wasn't his product, McDonald's was the product. Take a slide.
Can I just, about what you just said, I'm just trying to process that.
Mhm.
So why is the hamburger not the product and basically the business is?
Oh, if you want to.
So when you create a business, I think the goal is to create a system that generates money and profit. You're selling the product as a hamburger, but you're creating a business. It's the systems involved in getting the hamburger from the freezer to the consumer in the most efficient and the fastest way possible that actually makes you money.
And that one could be replicated any times over by any person. So their business model was to sell that, not to sell the specific hamburger, but to sell the ability to sell hamburgers.
Okay. Yeah.
So it'd be the same if you're starting a construction company. You might be really good at framing houses, but it's being able to frame houses really quick, multiple times over, where you create the business to do that.
Did you?
I was just gonna say, it's probably more so about the experience that you're selling. The hamburger is the product, but I guess in marketing terms, it'd be more about the experience that you're trying to.
And a big part of McDonald's success came from the fact that they were franchising like crazy. They were the biggest franchise company in the world. And so when you're taking a look at all the people even in town that opened up, say, McDonald's franchises, they could have gone and opened up a burger stand, but they didn't want to. They wanted to open a McDonald's. Anyone can go and get that beef from somewhere, right? They can get the cheese from somewhere, the milk from somewhere, the eggs from somewhere, and start their own business. But they wanted that McDonald's name, that franchise, and most importantly, the systems put in place. So McDonald's comes in and says, cook for this long, this is how much it should cost you. And it takes a lot of the concern away from franchisees or from entrepreneurs as well.
Yeah. So McDonald's will roll in with their ovens, their equipment, and their methods to get the hamburger as quick as possible out the door.
And the experience as well. You're right with that part.
And consistent, right?
Yeah.
Yeah.
But
And
as a
that's
small business who's not looking to franchise, maybe ever, are you then using that as an example to make sure you have everything planned that way so anyone could take it over? Is that kind of why we're using that as an example?
Mhm.
Yeah, it's also a risk management thing. So one thing we discuss with a lot of our businesses is what happens if something takes you out of the equation. So it could be something delightful, like you want to go on a vacation, and it could be something sad, like a family issue, or you walk out and have an accident and can't be there the next day. Can the business continue to run without you?
Okay.
And more importantly, for those of you who might be the big entrepreneurial style, the people that you put in place, can they run the business for you? And can they be replaced? Do they have the systems and operations in place that if your manager picks up and leaves, you can still run your business successfully?
And that's, like, right now we're talking about the operating system, so this is the system in the company which creates the work or the product. So the key is to have a system that provides consistent value to customers, employees, and suppliers. And typically this is operated by people with the lowest possible skill. So if you look at McDonald's, they don't have PhDs running the ovens in the back. The system is built so you can have anybody step in and put the hamburger in the oven and take it back out. And your operating system should make your business stand out as impeccable order. So your business says to your customers that your people know what they're doing. And you build trust with your customer and employees. And you should have all your work and procedures documented in an operations manual. So as Colleen just said, if something happens to you or somebody in your family, if you're gone, somebody else can step in and take over.
Okay, so in the HR and people management, we'll discuss human resource management, job fulfillment, and 3 signs of a miserable job. So, human resource management. The people in your organization run the system. Maybe the hardest component of the balanced scorecard to manage. The cost of employee turnover is really high, so when you look at your business, you're looking at recruiting, retaining, and developing. All of this costs money, and if you cannot keep people, you'll have to continually invest in new people. There's a quote about this that says, "What if I pay all this money and train our employees just to have them leave?" The owner would respond, "What if we don't invest in training and they stay?" There's also termination issues, which are the least fun of HR management, but an important thing when you're running a business never to ignore. The important thing is always to deal with poor performances, so verbal, written. You run into issues with termination with or without cause, and all types of issues can arise. There's a higher onus on the employer in proving cause, and just a note we say is generally a rule of thumb is 1 week notice or pay for every year of service.
So, would you be documenting and evaluating these people so that you would have backup if you had to if there was any question on termination?
Absolutely.
Yeah, and so I guess I would go twofold with that. Yes, if there was a question on termination, but also yes, if they stay with you. One of the biggest things we ever hear is people want more feedback, good or bad. Feedback allows you and your employees to adapt to what you're doing. So if they're struggling with something and you feel like you've continually explained it, maybe it needs to take another explanation route. But yeah, in the case of termination, it definitely does kind of create a breadcrumb trail that can be followed.
And a lot of times it's best to talk about issues right away instead of just building up inside of you and not dealing with the issue. If you talk to the employee, maybe they're having issues understanding something. Maybe it just takes a little communication to fix a little problem before it gets really big.
Yeah. Okay, so are your people willing and able? What are their technical skills? Are you checking references? So for recruitment, we want to look for people that will fit into the business vision and values. A lot of those people will want training and support. Recruitment is sometimes a challenge due to privacy laws. So references, you can check for those where they worked and how long. Sometimes they will only be able to give you factual information, or the companies you're calling will only offer factual information. So you have to be kind of careful with that. Ensuring a high level of communication to ensure people are happy. This is the way to measure what employees think. Look at your employee turnover rate, and especially if you do have high turnover, look to see why you're losing people. Most employees that are leaving will be kind of honest and tell you why they're leaving. So take advantage of that. It's free feedback on your business. You can choose to value it or not value it, but asking the question is quite important. So on the slide, we have the benefits of job fulfillment. The key to remember is how to provide job fulfillment for your employees. I'm sure everyone in this room has had a job or two before, and we've all had good or bad bosses. And you can probably think of what made them good or bad bosses in your mind. Know that there are a lot of things you can do as owners to contribute to your employees' job satisfaction. Which leads us to the 3 signs of a miserable job: anonymity, irrelevance, and immeasurement. New slides, guys, sorry. Want to discuss them?
Okay, people cannot be fulfilled in their work if they're not known. If the owner or manager cares about us, they'll take an interest in us. When a manager does that, whether you're in a Fortune 500 company or in a small company, if you're working in a hospital or a professional football player or receptionist, if you take a genuine interest in your employee, both in work and outside of work, after work hours, it's really difficult for you to hate your job. It's also a job misery creator, but getting to know somebody is a fantastic way to help them feel good about their job, and it's free. We need to ask, as business owners, need to ask yourself a few questions. Do the people I work with really know that I care about them as a person? Or can I say that I know a lot about them and what goes on inside their personal lives? Irrelevance. Everyone needs to know that their job matters to find fulfillment, and a manager's job or a business owner's role is to remind employees on a regular basis who they're helping and how they're helping. In measurement. So if somebody has a job and they have no way of measuring or assessing their success, how successful they are, or how well they're doing, it's really difficult to love your work. So the key is to make your employee's job measurable. So something great about when somebody says, hey, how are you doing this month? You can look at something measurable and say, I sucked, or I'm doing great, and not well, I don't have any idea, but I worked for 40 hours. This doesn't have to be linked to pay. If you have a way to measure performance, if you don't have a way to measure performance, you lose interest. And tangible performance reviews on a regular basis helps measure this.
This is the business model for professional service businesses. At MNP, we follow this quite closely. It's called the Lubrum model. So L is for leverage, which is your total personnel per owner. U is for utilization, so your chargeable hours over your total hours. How many of your hours are you spending on your client versus how many of your hours are you spending doing tasks or, admin work? B is for billing rate, so your total billings divided by your chargeable hours.
What's the difference between that?
Between U and B?
Between your total billings and your chargeable, is that like your cost versus your revenue? Is that what that, I know you guys have it under, that.
So for your total billings would be, say, this month I billed out $10,000.
That's your revenue.
That would be my revenue. But if my chargeable hours was 1,000 versus if my chargeable hours were 200, I'm obviously doing way better if I got the same amount of income for 200 hours versus 1,000 hours.
Okay.
So if you have, for example, like a retail store, would those chargeable hours be the hours they were open in a month that they could make those sales, or how would they figure out what those chargeable hours are?
Yeah, this is generally used more for a service business where there's something kind of less tangible. There's not 8 shirts sold. There might be 8 projects ongoing. It could be used in that instance as well. Realization would be your total billings over your fees generated. So how much of your fees, if you spent $10,000 of internal cost of your own hours and your supplies, how much of that did you bill to your client? And margin, what's left? So the next slide adds some numbers to make it slightly more tangible. So if we have 28 employees and 4 owners, our leverage is 7. If we have 30,800 chargeable hours over 28 total hours.
The first one's the dollar value, right?
28 employees.
20 employees, sorry, the first slide was wrong. Our utilization is 1,100. The billing rate would be $175, so that's our billings over our chargeable hours from the previous example. Our realization is 85%, so our billings over the fees generated, we got back 85% of what we put in. And that's including a value on your own time as well. And then our margin is 40%. Oh, that was the slide. This is just a model. It's not to be used for all industries, but, oh, you blew it. It's just a model. It's not to be used for all industries, but it's something that we do focus on a lot for our professional services. We have tax up next. Reese was really proud of this slide, so I'm sad he wasn't here to share it. But
I think this is one slide, like everybody should take notes on this one.
Yeah.
Because these are the 4 quadrants of any business that will make you successful. And financial is the last one that you should worry about.
which is an uncommon thing to come from accountants, but if you get the other 3 quadrants right, chances are you're going to get the financial one right. That's the easiest one to dial in when you have everything else lined up.
Would you say there's one that really you can't win without one of those, or like one that maybe takes a little bit more of a priority over the others?
So if you look at customers, like the key to customers is to attract customers that you want and to retain them. So if you look, customers will drive sales. If you look in the financial quadrant, you'll see sales. So if you get as many customers as you want, the right customers, and keep them, it'll drive sales. So operations is to do lots and do it right. So that's making the product, whether you're making shirts or building houses, is to do as many as you can as fast as you can. So that will reduce your direct costs, which will increase your gross margin. People, so if you can have the best salesperson, which will drive revenue, but if you have somebody that's not motivated, who doesn't want to work there, it'll turn customers away. It's going to impact your revenue. You can have the best salesman, but a crappy person doing the work, building houses that you have to go back and redo work. It's going to impact your gross margin. You're going to lose income. So it's all 3 are tied together. So any important one, I would say people almost. If
Yeah.
there was a key one.
We would go back, I would say customers or people, kind of depending.
So if you have like good staff, you've got your base.
Yeah.
Yeah, but certainly if you have one and you have 3 weak ones, your business won't work. It's trying to increase all of them as much as you can. And often we'll sit down and just kind of go through and say, what can we do to fix customers this week? And next week it'll be operations. But kind of keeping a continued circular focus on all of them.
Sure. Cool. Thank you.
Yeah.
When looking at the people one, you said there's a really big focus on keeping your staff motivated. Do you know, I mean, I've read a lot of things about how money is not the biggest motivator, but how realistic is that, do you think, is, the best way to motivate your staff, monetary or physical? And I'm not saying now, like, me telling the receptionist that she's doing a great job, that's not, obviously that's a great motivator, but I'm talking about a direct incentive. Is monetary better? Or is things like a staff retreat or things like that, like to motivate them to up the other 3 quadrants?
It's actually a really highly studied thing.
Yeah.
And there was one study, I'm trying to remember the stats, so I'm not going to give you any numbers, but basically what they did was they offered a ginormous carrot. And they said, if you meet these 3 things, we will give you a boatload of money. And more people were demotivated by that than were motivated. When they offered things like, you're still going to work 5 days a week, but on Mondays for 3 hours you can do whatever you want. Whatever project has been sitting on your desk that you want to work on, you can work on that. And if you have a new idea, you can work on that. And if you just need to get, a few things done, you can work on that. That was a bigger motivator than funds. And that actually, for this company, ended up generating them more money because all of their employees focused on development and they came up with a bunch of new products.
And just a little bit on that, there's been a lot of studies, especially about the money side of things, because managers love to save, and business owners love to save, and labor is always the #1 cost to a business, 90% of the time. And there have been studies that show that the big thing for all of your employees is going to be, do they make enough to live?
Yeah.
Do they make enough that they don't need to get a second job? Past that, the return on their happiness isn't nearly as much as what it is when they're building up to that point of being comfortable. So I mean, and I'm gonna take up a little bit of time, but one of the companies that I worked for was GE Capital. GE is one of the biggest companies in the world, and they had a huge client retention rate, specifically in the part that I worked in. And it wasn't because of the money that they paid you, it was because of the support that they gave you as an employee. So for a big company, they didn't just give you a number and say, you're employee. I still remember when I worked for a company, I still remember all my employee numbers, because to the company I was that number. But with GE, that wasn't the focus, and they had some of the highest retention rates in the industry in Canada. The average for this job was 30 years. And so that just goes to show you what can happen when you make your labor and your employees happy. It's not all about making them millionaires.
I might add to that too, if you don't mind. So, I mean, like even Community Futures, right? I mean, we're a small office, we're 4 people. Our money has been the same, our base funding has been the same since 2008. And so we have to come up with different ways. We have 4 people, we all love what we do and we care about business, but at the same time, you've got to come up with some things that really entice people to stay long-term, right? Because our relationships with our clients are key. So I mean, things that we've been able to do is like close the office between Christmas and New Year's. How much work really gets done in most places anyway. But that's key. I mean, sometimes it turns out to be a week, sometimes it's 8 or 10 days in a row. So on top of your vacation, you can do that. Jason's expecting a baby. They'll be expecting a baby soon too.
Not tonight.
Not tonight, yeah. But you know what? Just being flexible, right? I mean, it's got to be a win-win for the employer and the employee. Like, you know what? You give me extra hours, you do extra things, and you know what? When that baby comes, you just run, right? That's because making people happy and their quality of life and the time they have at home is like really important. We work as a team, so we set goals as a team, and if we achieve it as a team, then based on our income that we generate for other things, then we share that in an RSP or something. But we're team motivated. It's not like if Jason does something really good and I do something really bad and somebody else does, it doesn't make a competition. So it's like, okay, in order to hit our targets that we have to, for our funding, how do we do this and how do we go out there and promote it together? So, and making just people happy. Sometimes it's as simple as, somebody's downtown and bringing lattes for everybody and taking an extra half an hour just to chat and say, what's going on in your personal life? You know what? Just working as a team, I think is so rewarding, and those are things that people overlook.
Yeah. And talk to your employees. A lot of people will be open with what they want, because when you tell them that money isn't always the answer, you can't give everyone $100,000 a year, ask them what they would see a benefit from. Yeah. And a lot of people will be really receptive and tell you, well, you know what? I want to go and get a gym membership, I can't afford it. Oh, so maybe you do a health and wellness where you pay for half their gym membership, and that's really the goal, is to get to that point where you can have that open conversation.
Okay, I think we'll just roll right on into structuring our business.
See if you can pick who's up next.
Okay, well, you guys.
Like you with glasses on. No, I just had mine, so I'm
okay.
good. Yeah.
You're
It's
good.
in here as well.
Should no, it's different.
Yeah.
Yeah.
It's in this one.
Yeah, the other one. Hello everyone, my name is Mark Carrig. Thanks for having me here tonight. I am here to talk to you about
tax considerations for small businesses. Eventually. Oh, there's the, okay. So here's an outline of what I'm going to get through tonight. We'll start by looking at the differences between a sole proprietorship and corporations. We'll look at some advantages and disadvantages of incorporating for your small businesses. We'll look at corporations and the tax deferrals that they can offer to you, as well as paying wages versus dividends out of your out of a corporation. After that, we'll get to some examples regarding whether you should incorporate or not, and the differences between paying wages and dividends. After that, we'll go to deductibility of expenses, and we will look at some of the deductible expenditures from your business, as well as some expenses you may incur that are not deductible for tax purposes. Following that, we'll go to payroll, and then goods and service, or GST, I guess, and questions after that. If you guys need clarification on anything during, just raise your hand and I'll try to get to it. A lot of the following slides will answer some questions as we go as well, so we'll get started. So one of the main questions that entrepreneurs have is, should I incorporate my business? And there is really no easy answer to that. It's kind of unique from situation to situation. Some advantages that you will get from incorporating your business, however, will be flexibility of splitting income with family members. So what this is it allows you to pay your family members instead of taking out a whole amount by yourself, which will be taxed at a higher marginal rate. If you split it amongst other family members, it will be taxed at lower marginal rates, and there will be some tax savings there for you. Next, there's potential access to capital gains exemption if you incorporate. So you'll buy shares in your corporation for a nominal amount, say $100. As your business grows, these shares will increase in value. If you decide to sell them at a later point in time, you will incur a capital gain, and the access to the capital gains exemption will allow you to not be taxed on that capital gain, which will also provide more savings for you. Another advantage is the flexibility and remuneration options. So you have the ability to, in order to pull money out of the company, you will either have to pay yourself a wage or a dividend. And we'll get to more in detail on this later on, as there may be some inequalities between the two. Another advantage is creditor protection. So if you're in business with your business partner and that person makes some terrible choices along the way, and say your business is now being sued or anything like that, the corporation will protect your personal assets. So they can come after your business, but they can't come after your house or any other personal assets. And then lastly, there is the ability to defer tax by incorporating.
Meaning?
I'll get to that, yeah. Some disadvantages for incorporating your business. There are costs of incorporation that you will incur right off the bat, as well as annual filings. So these are annual costs. It can be more complex if you have a corporation. You will now have to file, in addition to your personal income tax return, you will also have to file a corporate income tax return. There's potential for more detailed financial reporting. If you're looking to grow your business quickly, you may take some money out from there, get a loan from the bank, and in order for the bank to provide the loan to you, they may want third-party prepared financial statements. So accountants, we prepare those, and that is another cost you will incur.
They 100% will need you to get third-party prepared financial statements if you're looking at getting lending from a bank. 100%.
And another disadvantage is startup losses will be trapped inside the corporation. So many small businesses, not all of them, but a lot will incur losses the first couple of years while they're taking on additional expenses just to get everything up and running. And so if you incur these losses personally outside of your corporate, or not in a corporation, you can apply these against other sources of income that you have. So whether it's employment income or any other types of income, it will reduce your tax rate personally that year. If you have it in a corporation and you've never had profit in your corporation, these losses will be trapped until you generate revenue at a later year. So they're kind of just stuck in the corporation, and you get no tax savings from them until you generate a profit. So the tax deferrals. A corporation does not provide, or you shouldn't look to get absolute tax savings from a corporation. We will see later on that you can, there are ways to save tax by incorporating, but that isn't really the main motive of a corporation. Corporations are more of a tax deferral mechanism. So corporate tax is initially paid at a low rate inside the corporation. In order to get that money out, like I had mentioned, you're going to have to pay yourself a wage or a dividend, in which case you will now have personal income, which will be taxed at a significantly higher rate depending on your income levels. However, the deferral comes into play when if you have the ability to leave money in the corporation. So if you don't have to pull all of it out for personal use and you can leave it to help grow your business, there is a deferral there that means more money for you now and potential tax later. So the tax deferral advantage. The personal tax rates in Alberta range from 25 to 48%. So this is Alberta and federal tax combined. So if you don't have a corporation, you will pay income tax at a rate in between there. However, if you have a corporation set up, your tax rate for a small business for income less than $500,000 will be 13.5% combined federal and provincial. So you can see there's a pretty significant gap between the income tax in a corporation versus the income tax in on income earned personally. So any income not required for personal living expenses that you can keep in the corporation will be left inside the corporation and taxed only at this low rate until a later point.
So just to clarify,
Yep.
that 500,000 of income, that's what you draw out of the corporation as either your dividend or?
The $500,000 is a limit, so that's anything above that you're going to pay a higher tax rate on. So this is called kind of the small business rate.
And that's the sales for your business?
It's the profit for your
Profit
business.
for your
Yeah,
business.
taxable income, I guess. So the money you generate inside your corporation, so whether it's $100,000, you can keep that in your corporation. However, if you don't have another job, for example, this is your only source of income, you're going to need some of that personally, right? And in which case you'll have to pay yourself a wage to get that money out of the corporation in your hands personally, or a dividend if you're a shareholder. So I don't know if that answers your
So
question.
your corporation pays the 13.5.
Yeah, and if you,
Then when you,
okay, go ahead.
then when you pay yourself,
Yeah,
then you're also taxed personally?
yeah, you will pay 2 levels of corporation. We'll get to this more. It's not, or 2 levels of tax if you have a corporation, sorry. It's not as bad as it sounds. There's kind of a mechanism in there to even it out, so you're not paying double tax per se. But it sounds bad. So yeah, any income you can keep in your corporation will be just taxed at that one level until it is pulled out personally at a later date. We'll cover more on that example later. It'll hopefully become a little more clear. As I discussed earlier, you can pay wages or dividends out of your corporation. So there are advantages and disadvantages to both of those. For wages, these will be deductible to the corporation. So these you actually won't pay tax on. This is a deductible expense. It will reduce the amount of income you have in your corporation. If you pay this out to your employee, they will generate RRSP contribution. So this is fairly important to a lot of people if they're looking to put money in investments and let those investments grow tax-free until they retire. However, you will be subject to the full rate of personal tax, which I mentioned earlier was at 25 to I think 48%. And you will also be, as a business owner, subject to CPP and income tax withholdings. So, as the employee, I guess, you will be required to withhold income tax on the wages you're receiving. You will also be required as an employer to pay CPP for the employer portion, as well as remit for the employee's portion. We'll cover more of this later as well. Dividends. These are not deductible to the corporation. These will be taxed in the corporation and paid out of after-tax funds. The benefit, I guess, would be that they are eligible for a dividend tax credit. This will reduce the amount of tax you pay once the dividend's paid out to you and received personally. You will have less tax as a result of the dividend tax credit. You will not be subject to CPP or income tax withholdings when you pay a dividend out of your company. And keep in mind, dividends can only be paid to shareholders of your corporation. Wages to anyone, obviously. You will not generate RRSP contribution room with dividends like you will with wages. So as it says here, each person's situation is very unique, and therefore it is very important to think about this type of stuff, and if talk to your accountant on an annual basis to come up with a plan that meets your personal needs. So I mean, some people need more money than others personally. Some people want their business to grow as fast as they can and will want to leave cash in there. So the first example, corporation earns $100,000 in taxable income in 2016. The shareholder requires all of the after-tax funds for living expenses, so they're going to pull all the money out. The shareholder will have no other source of personal income, meaning the deductions, the personal tax deductions will be available for this example. Should the shareholder take wages or dividends? Any guesses?
Wages. Let's guess 50-50.
Okay, we'll look at option number one, paying $100,000 of wages to the shareholder. So the total income earned is $100,000. You will receive this personally. The corporate taxes payable on this is zero because they get the $100,000 deduction in the corporation. So I guess when I was saying earlier, you don't pay double tax on wages, just on dividends. Personal taxes payable is about $24,555. This is slightly less than the 25% I had initially quoted because there are credits available that reduces your total income earned on the top line. You will have CPP contributions payable. So the max is $2,500, and that maxes out at about $50,000 or $55,000 in wages. However, as the employer, as the corporation, you're going to remit for the employer and for the employee. So double 2,500 is roughly 5,000 or 5,100. So your after-tax cash after you pay these wages to yourself is going to be $70,000, $70,356. Option number two, pay a dividend to the shareholder. So your total income earned is still $100,000 in the corporation. The corporation will pay tax at 13.5%, resulting in $13,500 of corporate tax. Personal taxes payable is significantly lower than the $25,000, and this has to do with the $13,000 or the after-tax cash being paid out by the corporation, so $100,000 less to $13,500, as well as the dividend tax credit I mentioned earlier. It's a significant credit compared to just paying a wage out. So your after-tax cash and you will not have CPP contributions payable as that is only on wages. So your after-tax cash of paying a dividend out to the shareholder is $77,530, which is $7,174 better than if you had paid the wage. So in this case, it is more beneficial to pay a dividend to the shareholder.
Can I just ask a
Yep.
question? Sorry, full being in the room. How does that affect the company, the incorporation?
Can you elaborate a bit?
Like, if this is the shareholder, if they took a wage in the first category versus if they took a dividend in the second, is it the same to the corporation in option 1 or 2? Does anything to the corporation change?
This is just about remuneration, this is just about how
Okay.
you get your money out of the company.
So the company wouldn't be affected either way?
They're going to pay out $100,000 regardless of which option. They might pay tax. As an owner, you won't care either way. Like you're gonna, the after-tax cash number is the one you're really worried about. Is where's my money going? And in this case, $7,000 more will be going to the government.
There's other implications as well that I saw, especially in the banking world. Like for example, banks don't rate dividends as income. So if you take out an entire income of say $300,000 and go to the bank, to get a loan, and if that all of that money is in dividends, the bank will not count that as income when they're factoring how much they can give you, because dividends are not guaranteed. And that's why it's really important to pay yourselves a livable wage out of your business as well. Figure out what that comfortable debt level you need is, how much you need to facilitate that, and then after that, look at the dividends as well.
Okay, example 2, you're an unincorporated business, so there's no corporation. This is all just being earned personally and will be taxed on your personal return. Personal income tax return, sorry. You earn $100,000 in taxable income in 2016, similar to the prior example. The owner will also, in this case, require all of the after-tax funds for living, and the owner and spouse have no other source of personal income. So we throw a spouse into the mix here as well. What would be the advantage of incorporating?
So just to back up, you can only split your income if your wife or husband is actually a shareholder in your company. If you're the only shareholder of the company, you can't flow dividends to your spouse, because dividends only go to owners of companies.
So shareholders have to be.
There's special extra tax for kids under 18, so don't go playing with that.
But when they're 18, it is also an option at some point to bring them in if that's what your plan is. And as Hilda mentioned over there too, you can pay a wage to your spouse if they're involved in the business, but if they're not involved with the business, you have to make sure it's reasonable, or else CRA will assess that and say, you're trying to split income here and we want our money. So option number 1, the owner earns $100,000 in income as a sole proprietor. So the total income earned is $100,000. The personal taxes payable is $24,555, and the CPP contributions payable is $5,089. So this is the exact same number we came to earlier. In this case, we're assuming that the spouse is not involved, and therefore they cannot take a reasonable wage out. So there's no income splitting coming in play here. Option number 2, you incorporate and you split dividends between the spouses. So the total income earned is $100,000. The corporate tax payable is $13,500 at 13.5%. Personal taxes payable has gone way down compared to our previous dividend example, and that is a result of using 2 people's personal tax credits as well as lower marginal rates of income. So there's a pretty big tax savings there. So your after-tax cash here will be $82,814, which is the tax savings of the prior option of $12,458. So pretty significant difference there. Any questions?
Do you have an example where it would be unbeneficial to incorporate later on in similar situations?
If you go one slide back.
Yep.
To the previous example. So here it shows that as an owner and not being incorporated, and with your income earned of $100,000, your after-tax cash would be $70,000. That's the exact same result as when you had $100,000 in your corporation, but you needed all of that money for your household to fund your expenses personally, right? And because it was the exact same number, that actually tells us that it's more costly to have a corporation, because the corporation has expenses. Like you have to pay your legal fees to get your annual returns filed. You have to pay separate accounting fees. You have to pay for a number of things just to have that corporation. So really, that's an expense. So if you're gonna pull all the money out of it, and you're only looking at it from a cash and a tax perspective, then there's no point to incorporate. But there's many other reasons to incorporate as well, right? Like if you're worried about legal liability, that's a really good reason to incorporate, for instance.
Is there an income threshold about which incorporating makes sense? Or
It depends on your personal situation. Like if your business makes $50,000 a year, but you don't need a dime of it for your personal living because you married well and your spouse is doing really well and funds all of your household, then you can leave that $50,000 in the company. So then you get that deferral. So for some people, the threshold is $50,000. For others, it's $250,000 because they they need that much money to fund themselves, right? Does that answer your question? Does that create more questions?
Well, so I just had a question, and it didn't create more questions, but, so for small businesses just starting up, does it make sense to start as a sole proprietorship? And then once you grow a little bit and start having sales, then can you convert to a incorporated company?
Yeah, you can do it at any point. So I mean, it may not make sense early on, but as you kind of establish yourself and get some sales, and then, I mean, like she had mentioned earlier, Hilda had mentioned earlier, it will be completely different for everyone's personal situation. So I mean, there's no real easy answer to it. Like, it might be, you may not want to incur the extra costs of incorporating early on. So I mean, it may not be beneficial, but.
And just to add to that as
Yep.
well, is just those losses that Mark mentioned earlier. If you're incorporated, those losses are within the corporation. So you can use those losses within the corporation if you later on have profits. But if you are a sole proprietor and you have losses, you can actually use those losses against other sources of income. So if you have wages from another job, you can completely offset those wages to the extent that you have losses from your business. So then it's a real tax savings, and that might really help in the first couple of years starting up, right?
The other thing is that a lot of times this isn't, depending on the industry you work in, you might be told, we'll give you the contract, but you have to incorporate. So a lot of people will say that. If you work anything oil field related, they won't deal with you unless you have Anchor Limited. So sometimes it's not a decision that you get to make. You make that decision because there's a big carrot at the end.
You had a question?
So, for the legality purpose of it, if you are starting with nothing and you have to personally guarantee in the beginning, will your corporation protect you at that point?
If you personal guarantee, they can still come after, like obviously you're using personal assets to guarantee the loan. But there is a point where you could get big enough as a corporation, they'll hopefully drop the guarantee and then only need corporate assets to do that. But yeah, like what I meant by creditor protection was the banks as well as lawsuits from anybody. So I mean, if you have a business and you've done something to somebody and they want to come after you, they can't come after your personal assets with the corporation. But a good question with the bank there. Anything else? Okay, we will.
The pension part of it, is something like don't, at what point do you, cause you wanna collect that pension downstream at some point perhaps.
The CPP
Yeah.
pension? Yeah, that's true too, but yeah, so I mean, you pay into CPP, eventually you hope that it'll still be around when you're ready to retire and you will get to collect on it, but that money that you don't put into that, you could also use to help grow your business, which you could put aside for yourself as well. So I mean, there's potential loss in growth there by paying any more than you have to.
Is there a magic number when you should quit paying or?
Not that I'm aware of, no. Anything to add over there?
No, that's completely personal.
Yeah.
Some people really like the idea of having CPP and having RRSP contribution room, and that's a personal choice. So if that's something that's really important to you, then definitely pay yourself in wages so that you can continue doing that. Other people are of the view that CPP might not be around forever and they'll not get their money back. So they don't think it's worth their while to pay into it.
If your whole operation goes south, at least you've got something.
Maybe.
That's a personal choice.
Yeah.
Any other questions?
Just expanding on what you said about paying yourself a livable wage, what are the other impacts of having that as a record that, what your income was versus just having something, living on dividends?
I mean, all I can speak to is my experience at the bank, right? And so, in terms of implications, the biggest thing that I saw impact small business owners was that they might make $250,000 a year, but 40 of that was wage, and 260 or however much of the rest was all dividends. So they would come to me at the bank and say, "Hey, I make $300,000 a year, give me a loan, and we take a look at it, and all we say is, well, that dividends, because any dividend is not guaranteed, right? And so next year, you may not pay yourself that $200,000 dividend, maybe it's a bad year, but wages are consistent throughout the entire process. I mean, as an entrepreneur, it's always up in the air, right, because it's your business, but the bank wants to see income, not necessarily dividends. I mean, that's a kind of a generalization, but especially when you're first starting out, that's when you need to be really careful.
Okay, reporting deadlines. Sole proprietorship, you will have to file your personal tax return by June 15th. So no longer April 30th as an employee, or if you're an employee, your due date was always April 30th. However, you will still have to pay your taxes by April 30th. So you kind of have to have an idea how much you're going to owe, pay it, and then you have an extension to file. Partnerships, you will have to file a T5013 return by the end of March. So a partnership will tend to have a December year end. Corporation, you will have to file your corporate tax return 6 months after the year end. And generally payment will be due within 3 months of, or at least 3 months, or by 3 months after year end. And with corporation, you can choose any month you want as your year end. Just personal preference for some people. They like to have, I don't know, not interfere with their busy times in operations or any other preferences, I guess. Deductibility of expenses. So what is deductible for your business or by your business? So deductible expenses include anything made for, or most things made for the purpose of gaining or producing income. Capital expenditures will also be deductible, but they will only be deductible to the extent of tax depreciation rates. So if you buy a vehicle in your company or for your small business or your sole proprietorship, you will not be able to deduct that full amount in a year. Instead, you will spread that deduction over the lifetime of the, or useful life of the vehicle.
So if you say the useful life of the vehicle is 5 years, but you actually keep it for 10 years, you only get, you don't have to ever claim it again?
CRA, I guess, decides what is the useful life of the vehicle. So most vehicles will go in a pool, and they will get deducted at 30% of the cost per year. So at a declining balance, so it kind of goes over, I don't know, it'd be 10 or 15 years by the time you get it down to not much of a deduction. So it's not up to us to decide.
Oh, I can't just say, oh, that
no,
truck's
no.
only gonna be good for 5 years, then I'm gonna just use it. No, okay.
Yeah, so like any capital item, so your furniture, your computers, anything like that will go into a pool, and you're kind of stuck with whatever CRA decides that you can deduct at that point.
Is the car maintenance tax deductible?
Yes, like automobile expense, it will be deductible, but it will be based on your percentage of use for business or your personal vehicle. Or like you're thinking if you use a personal vehicle for your business?
If a company has a
For a company?
vehicles, then they need to get their cars maintained.
Yeah, it will be deductible in a company, yeah. And will also be, if you don't have a company, but you're, you use your personal vehicle for business, CRA will require you keep a logbook and determine a percentage that you use your car for business and for personal use. Based on that percentage, you will have deductions like fuel, maintenance, lease payments, that kind of stuff will be deductible to you on your tax return. I'll start at the top here now. Meals and entertainment, you can claim a 50% deduction if it is related to a business or has a business purpose to purchasing the meal or the entertainment. As I mentioned earlier, computers or laptops can be deducted by a company. However, it will be over a period of time and not in the year that you purchase your computer or your laptop. It's a pretty quick rate though, so I think two or 3 years there's nothing left. So that's pretty good. Automobile expenses, as I mentioned earlier, you will be able to deduct a portion that is related to your business. So no personal amounts, and this is based on the logbook that CRA wants you to keep. And I'll touch on that again later.
Does anyone actually keep that logbook, realistically?
Yes.
Really?
Yes. Some people are better at it than but if you're ever in an audit, you're relying on that mileage book.
There's-
The best way to do it is just on your phone, just keep a running, like, memo going. That's what I've found works best for me.
And I don't wanna spoil the later slides coming up, but that is a highly audited area by CRA, cause a lot of times what people are claiming isn't their business use of their vehicle. So they know to look in that area, I guess.
Is that just for sole proprietors, not for corporations?
A corporation, you can deduct the expense, all of the expense. However, if you're a shareholder of the corporation or an employee and you're using that vehicle personally, you may have a taxable benefit on your personal income tax return. So you want to be careful with that as an employer, that you're not putting a unnecessary tax benefit on someone else's. Say if you have an employee, you don't want to burden them with a bunch of tax for using a vehicle. You want to make sure they're aware of that, I guess. Because there won't be any added income for that tax they're going to have to pay. Home office expenses. You can claim a home office expense. However, there are pretty strict rules as far as you must do business there on a continuous basis. It must be only for business, so your kitchen table is not your home office. And the deduction will be based on a prorated share of your office compared to the size of your house. So if your house is 1,000 square feet and you have a 200 square foot office, you're going to get 1/5 of your mortgage interest, your utilities, and your rent if you're renting your house, anything like that. Work clothes or uniforms, these are deductible assuming they're not generally used for personal use. So you can't buy clothes for personal use and expect to get the deduction.
Is that just for the shareholder or for employees as well?
As employees as well, yeah. Assuming you're only buying, or I guess if you're an employee for yourself, yeah, same thing.
So if you have an employee who like has crappy clothes but they're good in the office, if you want, say they can't afford to say, if you want to buy them $200 worth of office clothes, can you?
Then we're into taxable benefits, you know?
Yeah.
But if you want to make a uniform that everyone has to wear,
Then it's not taxable for them, it's not required.
Yeah.
And you can deduct it as your business expense. Travel, if there's a business purpose for you to travel, you can claim things like flights, hotels, half your meals. It's got to be business related though, you can't just be going on vacation and trying to claim. Convention expenses is another one. You can claim expenses for 2 conventions per year. However, you cannot go to a convention in Toronto if the same convention or type of convention is being held in Calgary and expect to get the full deduction. They will look into the reasonableness of your location, I guess. Any questions on these? Some non-deductible items include personal and living expenses. If there's no business use for it, then you're not getting a deduction. Fines and penalties, this would be parking tickets, speeding tickets, late payments to CRA. You will not be able to deduct any of that. Golf fees and memberships. And when the businesses, your small businesses have experienced a lot of growth in the future and you decide to buy a yacht, there will be no deduction for that.
What about like gym membership or stress management, stuff like that?
Well, I think there's very specific rules about it being available to all employees and some other
Sorry, what was the question?
gym memberships and stress management.
Yeah, so if you are providing gym memberships to your employees, it has to be available to everybody. It can't be that I would like to go to Anytime Fitness and you want to go to Lethbridge Fitness Club or whatever, or you want to buy a treadmill or whatever the case may be, because then it's not like the same anymore. But there's different ways of arranging that too, because you can have a wellness spending account where you say, okay, I'm going to allocate $500 for you to spend this year, but then it's taxable again.
It'd be absurd for a sole proprietor to have a deductible for like gym membership as stress management.
If you're the only employee, how are you going to argue to CRA that you are getting this by virtue of employment, not by virtue of being the owner?
there'd be an element
It's
of,
probably by virtue of being the owner, and then it's a personal living expense.
yeah.
Does that make sense?
What if your equipment incurs fines?
What type of fines? Like, law or like?
Yeah, it would be like, unsecured loading.
Yeah, none of that would be deductible. Like there are types of penalties that could be deductible. However, it's I'm a business owner and I get you to do some contract work for me. If you cancel the contract and I have a penalty in place in the contract, you could deduct that because I'm not I guess it's not law or anything like that. Like it's not a political type of law that's in place. However, anything that is a fine related, like a parking ticket, like I had said, or unsecured or insecure load, would also be non-deductible. CRA risk areas. So these are the most commonly audited items. So personal use of a company vehicle, as we mentioned earlier, you're required to keep a mileage log to prove business use, and if you don't have a mileage log, they will likely disallow any of the expenses you claim if you are audited. Meals and entertainment, they will also come looking for receipts to determine that you have only been claiming 50% of the meals and entertainment. And you want to make sure that you're not deducting personal expenses, as if CRA does discover that you are doing this, you will be subject to double tax on that. Payroll. If you pay wages to your employees, payroll will be required. You will be required to make remittances to CRA, including the employee and the employer portions. An information return, so a T4 slip, that's what you receive as an employee from earning employment income, is required to be prepared for the employee that is receiving the wage. So the payroll process, if you do need to make remittances to CRA, you will need to open a payroll account with CRA. So you can call them and just tell them you need a payroll number, and they'll ask you a bunch of questions about your business and go from there. You'll need to calculate the deductions. So these include CPP, potentially employment insurance, as well as the income tax withholdings. And then you will need to remit these deductions to CRA. I believe it's the 15th after the month end that you owe your remittances. So some people can be a quarterly remitter. You'll have till the 15th month after, or 15th day after the quarter's ended, or monthly remitters 15th day after the month's ended. And you will need to complete and file the information returns, such as the T4, which is due by the end of February. And if these are not met, or you're not making your remittances on time, or making remittances, you will be subject to penalties and interest from CRA. GST. Your business must be registered for GST purposes if you earn basically revenue from commercial activity over $30,000 a year. If you are registered for GST, you will be required to charge GST on the sales that you have. And while you are doing this, you'll want to make it known the amount you're charging the person for your goods or service, as well as the GST amount. You'll want that broken out on the invoice, because CRA may look into this as well. You will need to file a GST return with CRA if you are registered. You will remit taxes to CRA if the GST you received on your sales is greater than the GST you paid for supplies or any other expenses throughout the year. You will, however, receive a refund if GST paid on the expenses you've incurred throughout the year is greater than the GST you received from your sales.
I have a question.
Yep.
If you make less than $30,000 a year, you don't need to have a GST number, is that right?
That's revenue, so not necessarily your profit. But if you generate less than $30,000 in sales in a year, you won't need to register for GST. You might want to still, because you could get the refund.
So you can't charge your customers GST?
No,
either.
no, you wouldn't charge your customers GST, and then
Regardless of whether it's a GST item kind of thing?
yeah, yeah,
One donut instead of 6 type of thing?
yeah.
So how would the person know that they should be paying or they shouldn't be paying GST, like from a personal standpoint? Like if I go to a small company and they're charging me GST, but they're not making 30,000, they're actually just charging me more money on a.
Yeah, I'm not sure how you get around that. Like,
Actually, yeah.
years away. Yeah.
on your receipts, it should always show the GST number. And there's actually a GST check on CRA's website that you can enter that number in, and it will show you yes or no whether or not they're registered. So if it's an invalid number, you can actually go and apply for a refund for the GST that you paid, if you paid it in error.
So I have a quick question.
Yep.
So since GSTs are revolving, then you are charged GST when buying your products or supplies for whatever your business is.
Yeah.
If you're making less than $30,000 or in revenues, and you're not charging that GST out, are you able to claim that GST paid back?
No, you'll have to be registered for GST to make the claim, so you're
that's
gonna
just
be.
basically a lost 5%, I guess.
Yeah, like you would not get the 5% back that you're paying to someone else for GST if you're not registered. So I mean, just because if you don't have 30,000 in sales, it still might make sense that you get registered to try obtain a refund if it's there. There are some areas where there's zero rated sales, like farmers and stuff like that.
Yeah.
So it's very advantageous for them to get a GST number and claim their expenses, yet they don't really have much for GST for sales. And that is all. Questions on anything or everything?
I'm not sure if this is like a legal issue or not, but if you're a corporation and you can pay your employees in one bracket so that they basically will have a lower tax bracket, make up the difference in, let's say, company shares, do they get taxed on the value of the company shares as quote-unquote income? Or is that something they would get taxed if they choose to sell the shares a little later?
Okay, there would be, like this, wouldn't be as easy as it sounds. I mean, there's, I guess employee stock options would be kind of what you're getting at, but there would be tax ramifications at some point if you sold the shares that you had as an employee. So I mean, yeah, I don't know if there's a way to avoid tax in that situation. Like you might be able to reduce it somewhat, but it wouldn't be just as simple as giving people shares, though. There'd be a lot of other.
A lot of extra paperwork.
Yeah. There?
How often do you have to make your GST?
It can depend on your sales amount, so it could be annually. I don't know the numbers offhand, but it can be annually if it's below a certain amount, and it'll be on CRA's website if you're interested. And then if you're over that amount, it could be monthly or quarterly, and so it kind of all depends on your income level from your business. Yep.
In terms of the CRA, what's the most important to pay? So say if you're having a rough month, you know, I don't know, sales are really crappy because it's December and you don't do well in December, and you know that even after you paid everyone, you cannot pay both your GST and your payroll remittances. So you have, and you just know that no matter what you do, you just can't. But you can pay one of them. Which is the most important one to pay, and which one should you just take the hit on?
I don't think you want to take the hit on either, but the payroll remittances is a tough one because you're paying your employee a certain amount, right? And that should come off their paycheck. So you're getting a gross amount as an employee, but you never get that amount. You always have your deductions off your paycheck. So if you're going to pay that employee, and say you're going to pay that employee,
I don't really mean ethically. I mean like okay, let me rephrase this. Which has greater penalties? Being late on your GST or being late on your payroll? If you have to make that call. Or you just can't pay either.
I know it makes a difference, but I don't remember offhand which one it is. But there is a difference.
Payroll they really get antsy about because it's not actually your money.
Your own
Not
money,
it's
yeah.
your money once you've collected it, but you've taken that money from your employees and now not passed it on. They get really upset about that.
Yeah, you don't want to make CRA angry.
You gotta have your workers there the next day. So maybe glad for them.
Any other questions? Nothing? All right, thank you very much again for having us.
All right, guys, I just got a couple things that I want to say real quick. I know you're probably very anxious, but I mean, I think for me, probably the biggest takeaway that I got from tonight, it's kind of exciting because I get to do this the first time with you guys as project coordinator as well. And so the big thing that I would take away from this tonight is the fact that taxes are confusing. Probably one of the biggest pieces of advice I always give entrepreneurs is surround yourself with those specialists, because as an entrepreneur, you're going to specialize in your business. You're not going to specialize in taxes. You're not an accountant. You're not a lawyer. You're not necessarily someone who can do financing. So find those people you know and that you can trust and talk to them. That's what they're there for. That's why places like MNP exist. And I mean, that's why we had so many people here, great people here that could answer your questions and give in-depth responses. So next week, just as a brief conclusion, we're going to have a business panel next week. So we're going to have former contestants, former participants in the challenge, and real business owners right now. You guys are going to get the chance to ask them questions about the challenge itself, what actually running the business is like. We have one that actually deals with importing as well. So you can talk to them about the impact of this dollar that's ahead on them, which can be quite substantial. We're also going to bring in Westland Insurance. So you guys are going to be able to talk to an insurance professional, which insurance is so important as a business owner, especially when we're talking about liability. If there is any questions, I put my phone number up there for our office and my email address there. Feel free to get a hold of me if you guys have any questions, if it's about anything we've talked about tonight, or if it's about anything that's coming up as well. And follow us on Facebook and Twitter. And I actually took Craig Elias's word of advice, and I attempted to use the 7-second sell. So bear with me. If you sign up to follow us on Facebook and Twitter, you will receive up-to-date challenge information. You will gain access to business resources that will help you in the challenge, and you will build your understanding of the network that's available to you. So hopefully all verbs, right? All right, so unfortunately it looks like there was a mix-up a little bit, and we're pretty sure they delivered the pizza to the wrong place. So there's no physical pizza here. It's more of an emotional pizza. We should have led with that. It's a metaphor. But I do apologize for that. Do we have any questions before we finish, though, about anything? All right, adjourned. Thank you, everybody, for coming out.